Egie Akpata, head of capital markets at UBA Capital, is standing by for a discussion around the fixed income market. Egie, it's great to have you on the show. And I want to first of all get your thoughts on that Treasury Bill auction that we did see this week. Yields now falling below 10%. Many people are saying that's significant. In fact, some say it's very conceivable that we would see 8% yields at some point. First of all, your thoughts on the trend we're seeing in fixed income yields these days.
Okay, good afternoon, Wole. Yes, I think the T-bill auction on Wednesday was quite interesting that it had stop rates under 10%, probably the first time since September 2011.
Right.
What was also interesting was the bid cover ratio at the longer end, 364 days, 182 days, which was probably like four times. But then there was an OMO auction on Thursday, the next day, to mop up more liquidity, and the stop rates were actually above 10%. So it does show that you still have a lot of investors willing to lock in at just around 10 or slightly below 10%, but demand and supply has an impact on rates. And the more supply the government puts into the market, the higher rates will go.
So what sense are you getting? Do you think we'll see 8% anytime soon, or do you think we're probably going to stick around 10% for a while?
Well, I mean, we saw 8% in 2011 on T-bills, so it's not inconceivable that the rates go back to where they were before, particularly now that inflation is at 9%.
Right.
It's not inconceivable that you'll see rates around that 9% level. These negative real interest rates are not really sustainable, but on the short term, it's very possible.
Okay, let's move on to the corporate and maybe even touch state bonds. Are you hearing anything, first of all, about some issues? I know it's probably early in the year. Many of these companies, or rather many of these states, have to get their accounts prepared for any issue. So I get the sense that if we're even going to see any, it's probably going to be maybe late second quarter. Your thoughts?
Yes, typically because of the process of having to rely on full year audited accounts, which for just about all states ends in December. Reality is that they wouldn't have those accounts till March, April. So most of these bonds will start hitting the market by late Q2, like around June.
Right.
From then on, hopefully rates will still be good, and the issuers will be able to lock into very good rates.
Do you anticipate a very vibrant subnational bond issuance around that time?
Well, there are a number of states that are in process. I mean, those whose processes have been on for a while will be in a position to close by Q2. But those whose processes are only just starting probably will not be closing until end of Q3 or later.
And what about corporates? In fact, I was speaking to somebody recently, and he was making a case for even schools that have, if you like, very good cash flows, perhaps taking advantage of the lower yields that we're seeing these days to issue bonds. Your thoughts about the prospects of corporate bond issues given the interest rate environment we're seeing right now?
Well, I mean, the interest rate environment is ripe for corporate bond issues, given the huge gap between federal government bond rates, which are the benchmark, and borrowing rates for most companies. So it's expected that we'll see a number of issues this year. Of course, the same old challenge, year end for most of these companies is December. They're trying to close their audits, do ratings, and do many of those things. And that's why even when rates were very high, we always advise companies to get everything ready, get everybody on board, and just wait till rates are low enough. Because if rates stay low for a few months, and by the time you get your act together, rates have moved up, you would have lost the opportunity. So really, in terms of process, when you mention the small companies, the larger companies are normally in a better position to have most of the information needed for ratings, for the SEC, and all the parties involved, compared to much smaller companies that might not have the governance structures. The key is for all these companies to start early, so that when rates are in their favor, they can hit the market with all the information needed.
But speaking specifically about small companies, I just talked to you about maybe the potential of a school issuing bonds. Do you think that's something that could fly in this market?
I mean, it is possible. I mean, in other environments it has happened. The trick with this market, though, is that for a market that is relatively new, the high quality paper has to come to the market first, get the environment used to the market, deep in the market before the lower quality issuers come through. If a school comes through now, depending on the rating and if they're ready to go through the rigor of getting rated and all the requirements for an investment grade rating, because this market right now doesn't support non-investment grade ratings. If they could go through that process, why not? They could issue also.
I was just going to come to that point. You mentioned investment grade ratings being what this market likes. So are you saying that it's not conceivable to think that companies that are less than investment grade can issue bonds in this market? Of course, they'll have to pay a huge price, but Are you saying that you think it's highly unlikely we can see such issuance in this market right now?
Well, who are they going to sell it to? They certainly are not selling to PFAs, who even have restrictions on triple B acquisitions. And I don't see why a bank would be in a hurry to buy a bond that is not investment grade. So the market is not really there, and the way the rules are written from the SEC side, it's very difficult for a non-investment grade issuer to get out there, partly because the market needs to be protected from defaults. We need to have quite a good track record of instruments coming to the market and being paid out without any defaults, so as to build the confidence. If you have one or two issues that go bad with defaults, it could kill the entire market prematurely.
Right, so what I hear you say is that the regulatory environment more or less protects the investor, and so non-investment grade is not likely to fly in this market. Okay, let's move on to the federal government. We know that they've spoken about going to the, if you like, the international capital market to issue euro bonds. We haven't heard too much about that recently, but given where yields are right now, I understand that the Nigerian euro bond is closer to 4% right now. What are your thoughts about the prospect of Nigeria issuing at the moment, especially because we have oil prices where they are right now, closer to $120 per barrel?
Yeah, obviously, I mean, it's a good idea to do a foreign issue right now. Very low rates, very little supply still for good quality African paper. So given the move in the federal government rates all the way down to the 4% range, it's clear that there's going to be a lot of demand. And so when the government is ready, I'm sure they won't have any difficulty tapping into that market. And I understand it's a minimum of $1 billion issue, which is more reasonable than the smaller issue that was done in the past.
Okay, final point. I know it's always difficult to call, but where do you see yields going in the short term? Do you think we're going down, or do you think we're going to trade sideways for the next, say, 1 or 2 months?
Well, I think, just given the trend so far and the way the demand has been spread at the T-bill auction and even at the bond auction, it's not inconceivable that single digits will become the norm by end of this quarter, just based on the momentum that we have going right now. If there was a significant shock to the system somewhere, be it a central bank move or dropping oil prices, then all that could change. But based on the path we are on now, single digits by end of Q1.